Hello and welcome to episode 37 of Long Shots, our weekly podcast between me and Sharath. As you know, we have been changing a few things in this season. We're inviting our esteemed guests from different walks of life. Last episode was pretty interesting, Sharath. Arjun Guleria, he taught us a lot about digital marketing, distribution, positioning, a field that I don't think we were very aware of to start with, but we, I think, tried to demonstrate our intelligence through the conversation, right?
Yeah, I thought it would be our Achilles heel, but I think we managed to navigate that one. So we've had a fairly eclectic, diverse mix, and I'm really looking forward to today as well.
Because I think today is something that we can probably intelligently comment on.
To an extent.
To an extent. So that always, helps. But before we kind of introduce our next guest, I won't really call him a new guest. He's been associated with Transfin pretty much since we started. So he's an old hand. That's a good way to describe him. But before we go there, just a general guidance to all our listeners. We stream on Spotify, Deezer, iTunes, and pretty much any other eclectic and funky podcast app that you like. So do subscribe to our channel so that you get the nice little notification every time an episode goes live. So introducing Taponeel Mukherjee, reintroducing Taponeel Mukherjee. He has been an active contributor on Transfin. We also, I think, Taponeel recorded a video once where he spoke about capital as a broad area. Taponeel is running Development Tracks, an India-focused consultancy and investment business based out of Delhi. He's highly educated, highly traveled. He has been all over the block. I don't know, Zurich, Tokyo, worked at UBS, Citi. Welcome, Taponeel. Happy to have you here.
Thank you.
And in terms of today's agenda, I was thinking that obviously you look at, through your work and out of sheer interest, you look at infrastructure in a close manner. Now 5 years have pretty much transpired, and I was reading recently, like obviously we've gone through an election season where everybody expects post-election things to change, move about. Recently chanced upon I think it was Moody's which commented that the 2019 elections won't have much of an impact on India's infrastructure future. That's something that we can talk about. But let's look at last 5 years. What do you think were the positives, the negatives, both from the perspective of public policy and also from the perspective of capital flows and in execution of projects?
So I think if you look at infrastructure in India over the last 5 years, I think three key takeaways in terms of the positives were: one was the tremendous investor interest in Indian infrastructure assets. So I think what we saw was the ability of India to attract the best of global investors to come in and value and buy into Indian assets. So a good example of that is the first TOT auction that we had from the National Highways Authority of India. Macquarie came in and had a big transaction there. Right. So that's a good sign. What that shows is there's tremendous investor interest.
That you think
was a big positive in the last 5 years. Obviously, this has been in the making for the years before that as well. But sure. I think in the last 5 years, kind of saw that fructify.
Right.
The second space that saw a lot of interest was the push towards India obviously being a big renewable energy focused country. And I think what you saw was tremendous investor interest coming in over the last 5 years. Government policy was obviously geared towards increasing the participation of renewable energy in the energy mix. And I think that was an area that saw good progress. Obviously, a lot of work needs to be done. There were some policy tweaks probably in the last 1.5 years that did create certain issues, but that's a part and parcel of the game. You're not going to have a straight line growth. I think those sectors obviously going to take a lot of work, a lot of iterations to go through, but I think renewable energy was the second space that saw a lot of interest. Right. And third, I think, was the start that India made with regards to infrastructure investment trusts, so InvITs, whereby India in the last 5 years had a few InvITs come through the market, and it's still early days. I think both investors, that is institutional investors, as well as infrastructure developers in India are still figuring out the nitty-gritties along with the regulators and the government. But I think as a start, the fact that we've had those listings, the fact that people have started having the discussions in terms of how do we make these instruments better? Because eventually InvITs are going to be a huge complement to the debt and equity capital markets, and they will be structures that will be used to expedite infrastructure creation in India. So overall, I think the highways, renewable energy, and the progress we made towards InvITs are going to be the three positive highlights over the last 5
It's
years.
very interesting because obviously one is the perception point, right? I think the first point that you made was that in terms of perception for any foreign investor entering and eyeing the infra space, the entire ecosystem seems to have become more attractive, right? Second is obviously you are pointing more towards a particular sector, be it renewable energy in this case. And third is the third point when you talk about InvIT is more about capital, the mechanics of capital, right?
Exactly.
Let's look at all these three of them one by one. If you look at like from a perceptual perspective, why do you think suddenly foreign investors are finding India as an attractive space? I guess point 2 and point 3 are subsets of point 1, right, in a way. But what do you think actually changed that made foreign investors suddenly look at India as an attractive place? Was it the regulatory environment? Was it in terms of actual availability of greenfield, brownfield projects? What exactly happened?
Or just chasing growth as next big growth market in terms of tracking in terms of capital? Nikhil and I often look at sort of capital investments and credit growth to gauge how the economy is moving. So I guess that probably is also a factor.
I think it's a mix of factors, but I think Sharad kind of laid out the larger factor. At the end of the day, I think India is an extremely fast-growing economy. In the years to come, India will be one of the fastest growing in the world. It's one of the largest in the world. So if you're looking at it from an investor perspective, you need to realize that globally, if you're looking at these large funds, whether it's an infrastructure investor or a sovereign wealth fund or a pension fund, people are sitting, and these institutions are sitting on large pools of capital.
Right.
And you need a large market, you need a growing market to invest those large pools of capital. And obviously, India is a target for that. So in some ways, of course, India needs capital to come in to finance infrastructure, but India's need to attract capital is as much as is the need of foreign investors to come and invest in India. And that has been the single biggest driver. Obviously, once you funnel that and look at the micro factors driving the market, I think what investors are looking for initially is good brownfield assets. So if you look at investments that have been done, they've been primarily done in assets where the authority selling the asset was able to do it in a structure that was attractive to investors.
Right.
A third reason has been that there has been a lot of issues around non-performing assets in India.
Right.
And therefore, that has created an opening for capital providers to come in and essentially provide capital to businesses looking to exit those assets.
Would you consider that to be an add-on, or would you consider that to be a structural driver?
I think that has been a structural driver of attracting investments in India. The fact that a lot of large conglomerates, a lot of large businesses who had diverse sectors that they were looking at have had to essentially spin these assets up, and that's allowed investors to come in and acquire these assets. Obviously, the focus has been primarily on brownfield assets. Brownfield assets, essentially assets that are up and running. And also, if you look at India, what's interesting is investor interest is primarily also around consumption-driven assets.
Yeah.
So, I think when you look at infrastructure and you look at consumer-driven businesses, often people tend to look at it as like two different subsets. But the truth is that they're basically two sides of the same coin.
Right.
So if you're looking at investors interested in India, you want to invest into highways in India because you think traffic's going to pick up. You think interstate traffic's going to pick up. If you want to invest in airports in India, you want to invest in airports in India because you think as incomes go higher, Indians are going to fly more. If you want to invest in warehouse infrastructure, which is like infrastructure light, but warehouse real estate has seen significant capital come in, you want to do that because you think Indians are going to consume more, e-commerce is going to pick up. And so all those linkages is basically, this whole infrastructure ecosystem linkage whereby you have a consumption-driven economy, and that's going to obviously go up and down in the sense there's a natural business cycle. But overall, if you're an infrastructure investor, you're putting in money not for a year, not for 2 years. You're putting in money for like a 10-year, 15-year, 20-year horizon. So over the next 10, 15, 20 years, what you feel is that consumption-driven economy will create a demand for the infrastructure assets, and therefore you've seen all this money coming.
So just following up, like that's pretty interesting you say that, and this is again something that Nikhil and I in our first 2 seasons have talked extensively on how we've sort of benefited. When I say we, I say let's call it India and investments from dual effect of seeing a quantitative easing and rate downticks in the West and a simultaneous opposite movement here. Now that trend is reversing, right? So that, do you think that is a risk? Like, we've benefited from capital inflow. At the end of the day, like, be it REITs or whatever investment products, like they're chasing returns, right? Like, they need a yield associated with it. So there is that textbook, let's call it flight to quality or chasing high returns. Do you foresee that as something that needs to be really adjusted for, or is it just straight line extrapolation, something that can be done?
So I think you have a good point in terms of low interest rates in the developed economies have assisted the flow of capital into India.
Right.
But I think what's important to understand is, infrastructure investors are not investors who are what is termed essentially hot money or fast money.
Sure.
I mean, most of these people who are infrastructure investors have a structural need to allocate capital on a global basis, on a country basis, on a sector basis, and are looking for returns that are essentially fixed income in nature. Therefore, if they're investing in India, they're investing in India for a long-term horizon.
Sure, yeah.
So therefore, I don't see a situation whereby interest rates are going to go up in developed economies, if they will, and you will see
There'll be a
capital
capital
flight
flight.
from infrastructure projects. Of course, it's important for India to realize that if interest rates were to go up in developed economies, Indian assets will have to compete with global assets to attract new money.
Right.
But that's always going to be the case.
Yeah, that's a great point.
And so, if you're an investor sitting in an office in Tokyo or sitting in an office in Amsterdam, you have a choice of investing into infrastructure, but you also have a choice of investing into infrastructure in various different countries. You have a choice of investing into corporate bonds, into leveraged loans, into infrastructure. So eventually that allocation comes down. But India's advantage is that it's a large, growing economy
Right.
with, as I said, consumption that's growing and is expected to grow significantly in the decades to come. And that consumption is going to drive the real demand for infrastructure.
But like coming on to the consumption point, don't you think I would say the last 6 to 8 month narrative on the consumption story itself is becoming a bit hollow in terms of how sustainable that is? Because if you look at, like, for instance, I look at credit as a kind of a leading indicator, right? So if you look at credit, be it at a retail level, be it at a SME level, be it at a corporate level, I mean, there's a lot of there's widespread data and narrative coming on in terms of how it's slowing down, and that entire consumption bred growth premise. Do you see that weakening in the near term, or you think that because an infra person is anyways going to bet over the next 5-10 years, so the long term trend is more important here?
So definitely the long-term trend is more important here. So you will have consumption going up and down. You're going to have credit problems related to certain events that happen in the economy. But firstly, the long-term trend for consumption is the most important factor for an infrastructure investor. Second, if we've had credit issues around NBFCs, around essentially a lot of housing finance companies in India, what it really allows India to do is address the issue that Indian credit markets obviously need more sophistication, more granularity. At the end of the day, what Indian markets really need from regulators and from the government is security design,
Right.
and contract design.
Right.
Because it's unsustainable to expect that public sector banks are going to finance India's infrastructure and consumption boom in the years to come. So essentially, you're going to have to allow private credit to come in, play a role in the market, for which you need security design. Security design is businesses will have to start going beyond simple bank loans. What you will need is a capital structure that allows businesses to address their borrowing needs based on what their cash flows are, as opposed to simple bank loans. So what the recent...
I guess this is something that you're pretty philosophically bent towards, because I see that you've also written a lot on like wholesale banks and how a typical banking institution is not really equipped to handle long dated assets all the time. Is that something that you can kind of just elaborate on? What do you exactly mean by it? Why is the State Bank of India not equipped to lend to infra providers?
At a basic level, if you look at the average duration of state banks' deposits, that's the money that they're bringing in, it's around 3.5 years. If you're lending to infrastructure investors, or rather infrastructure projects, loans they need is for 10 years, 15 years, 20 years. So it is a structural imbalance that cannot work in the long term. Of course, I think public sector banks have to have a role to play in Indian infrastructure.
Right.
But we cannot be completely dependent on them to finance that infrastructure.
Right.
So now the question becomes, who is going to finance it? The problem isn't of a lack of capital. There is tremendous capital sitting that can finance infrastructure. The challenge is, how do we convince those investors that investing in India is attractive, obviously, from a return perspective, but at a very micro level, from a contract design, from a payment mechanism
basically you're saying
perspective,
that
how do you make it attractive?
the structure, the legal structure in which those investments can be pooled needs to be defined. And if tomorrow, if S hits the fan, how are people going to be protected? Their entire framework needs to be laid out. That is what is required.
Absolutely. And I think procedures like the IBC, Insolvency and Bankruptcy Code, are a step in that direction. But obviously, these are all processes that need incremental changes.
True.
So these are changes that need to keep happening for investors to be convinced that they can come in. And essentially, that credit slowdown you're talking about that has led to a consumption slowdown, that is obviously one factor for the consumption slowdown, the credit slowdown. That needs to be addressed by creating mechanisms that allow lenders to come into the market who can probably do a better evaluation of the credit quality,
Right.
so that we do not end up in a situation whereby we realize that credit quality has declined significantly
True.
with a jump risk.
Right.
In the sense, if someone goes from being a AAA to a AA to a single A,
You need that
triple
to
B,
be staggered out.
You
rather
need
than-
that to be staggered out. The
Right.
market needs to have that information, because what
Right.
that allows you to do is essentially for the market to price the credit better.
I guess that's the problem with corporate bonds as well, right? On the other end, like we keep on hearing why they are not deep enough, why the corporate bond market is not robust enough. I mean, even the biggest listed companies in India also fund themselves by bank credit, right? Which does not really make a lot of sense all the time. But I guess that lack of framework or transparency or legal enforcement is also missing there.
Absolutely. So that is a major factor that's missing, and obviously that has to be addressed.
Right.
And also, I mean, the bond markets have developed significantly in India. I mean, obviously with the last 10, 15 years, it's still a lot smaller compared to the equity market. But what needs to be done is develop the bond market and also create more liquidity in the government bond market. Because eventually, if you're looking at these corporate bonds, you're going to have a benchmark curve that's
Sets the price.
long dated
Yeah.
and that is liquid.
Yeah.
Because at the end of the day, when you're an investor looking at investing into a corporate bond for a corporate A, the risk you're taking is essentially the spread between that bond and the government bond. You're not interested in duration risk. You're not interested in interest rate risk in India. And I think as these different components, it's obviously a very, very complex ecosystem that has to evolve. And it is evolving. Obviously, how do you kind of expedite that process and ensure that these different angles and different aspects develop at the same time to ensure that the market can slowly start operating more efficiently, basically?
I mean, like that way, I think IBC, obviously, 3 years now since IBC kind of came in. And I guess the entire NPA piece that you were talking of as a positive, as a distressed opportunity where a lot of investors are tapping on. Besides the distressed opportunity, even the investors who are probably stuck in a lot of NPA cases are probably facing quicker resolution. So that, again, enhances the confidence and the perception for a third party coming into the Indian market.
Definitely. I think the IBC's been a step in the right direction.
Yeah.
People are resolving their issues faster than they were 5 years back. Is there a scope for improvement in terms of expediting the process further? There is. But I think it's important to realize that policy changes, as I said earlier as well, are going to be incremental. In the sense, there's not going to be this overnight policy change that's going to revolutionize the market. The real skill is, in a market the size of India, is change policy. You kind of take a feedback loop, you learn from the market, you learn from what's going on, and you make slow incremental changes to policy towards the right direction.
Yeah.
IBC's definitely had the case, and going forward, I think the real challenge and the real learning is going to be how do we expedite the resolution process even more through the IBC.
But IBC has gone through a journey of its own, right?
It has.
I mean, I recall when it kind of came in, there were like a lot of precedents which actually were set over the next 1.5, 2 years, be it rights of operational creditors, be it, in terms of right to appeal, be it promoters who are kind of going through NCLT, not being allowed to bid back for their assets. A lot of things have happened. What is missing? What do you think are the next steps for IBC to become more robust?
I think, without getting into technicalities, I think overall for the IBC, people need to understand why in some cases the delays have been a lot longer than what was priced in. And I think we have to go case by case and really look at those cases, the intricacies of the cases, and realize why those delays were there. And then it doesn't mean that the delays were for the wrong reason. It just shows that those complexities of the Indian market needs to get priced into the mechanism whereby we probably need to give these resolutions slightly longer. But what I'm saying is, if you say that something needs to get resolved in X number of days and that goes over that, then one has to address the issue as to why it's gone over, or whether it makes sense that these things can be resolved, or these issues can be resolved in X number of days. I think what's also very important, coming back to the NPAs, I think it's important for both investors and the government to start thinking in terms of how do we attract investor interest in non-NPA assets, in the sense, if besides the distressed sales, and by that I mean, how do you get investor interest to come in to greenfield projects, to new projects? And maybe by new, you don't mean setting up the project and operating assets, but there are a lot of incomplete projects in India. So how do you kind of get investor interest in that space? And that is going to get primarily determined by contract design, security design, and processes such as the IVC picking up steam further, because it's going to be a mix of all those factors.
Yeah, because I see, like, you know, and there's a fundamental difference, at least in my mind, when you talk about distressed assets. One are like financially distressed and one are economically distressed. Like for me, financial distressed assets are ones who are not able to meet their debt payments, and the way out there, and former bankers, it's probably restructuring or some kind of M&A play there, right? But when it's economically distressed, I mean, by definition, I'm thinking of those guys as NPV or future free cash flows as a negative number. So that's done. And I think the IVC framework needs to sort of address that difference as well, because I think now everything is just not performing, it just goes through that. That might be another...
it's I guess quite, it's blunt force.
It's blunt, exactly, yeah.
But I think those are the different intricacies that take time to figure out, in a sense, and that's not going to happen in 3 years or 4 years. It's more like a 5-year, 10-year process.
5 years? I mean, Twitter doesn't give that kind of a benefit of doubt to anyone, does it? That's where I think, that's the problem, right? I think when policy and economic policy discussions, that it's a bit of a divergence from our conversation right now, but I often feel that in the last 5 years, for probably post demonetization, a lot of the economic conversation happens in the political realm, and that's the kind of expectation a lot of like civil society and opinion makers unfortunately start getting as well, that everything has some sort of a political baggage, or why is, as you said, the incremental evolution, which takes years. Like, if you even look at like Chapter 11 in the US, right? It has a long history. It didn't come overnight, right? So, we are looking at a very, very, I would say, I'm not saying it's a perfect model, but it's a very highly refined and iterated model, right? And I guess when those conversations are subject to hashtags, that risk is always there, right? Obviously, we spoke about the positives, and I think while speaking about the positives, we also touched on a few negatives, right? In terms of actually closing the loop there. But you mentioned renewable energy, but from renewable energy, the thing that kind of I would naturally extrapolate to is the power sector. The power sector is in a mess, right? Overall, I'm not kind of demarketing renewable versus the rest, but if you look at conventional power sector, be it the state of distribution companies, they are all over leveraged, they are struggling to, get through. 2 questions. Number one, what do you think are the biggest issues there? Secondly, and that kind of, I think, also, plugs into the entire discussion on IBC that we are doing. Do you think that the entire, idea of India being a federal structure with, different laws at the state level and different rules and regulations at the central level, do you think that also has a role to play in making this incremental process even longer?
So I think in the power sector, if you look at the conventional power sector, obviously discoms have had serious issues, power developers have serious issues, and again, it's a mix of factors, right? So you're looking at the first and the most important factor is what's the price that the consumer should pay, and power obviously being a very, very sensitive topic in terms of being a fundamental utility. That is a topic that needs a lot of discussion, in the sense, if input prices are going up and you have a thermal power plant, besides the issue of the economic viability of that thermal power plant to start with, at the end of the day, who pays for that? And that is a debate that needs to be addressed. That is an issue that needs to be looked at, in the sense, if India needs to have a sustainable power sector, I think we need to really look at what should be the pricing of power. And that is not something that is an easy discussion to be had. Unless we price assets correctly, and pricing assets, and by assets I mean not the price of the asset, but the price of the service or the product being provided. And this applies to power, this applies to water, this applies to any fundamental utility.
Currently, these are all heavily regulated in terms of the pricing framework.
They are.
Do you think that we should kind of go more towards a market-driven framework? Or do you think that's not the correct answer? We need to just explore what the correct answer is?
I think we need to explore.
Right.
And we need to explore and create consumer confidence that we can come up with a solution that will be in their interest in the long term and will resolve the issues within the sector. So pricing of the asset is the first issue. The second issue, obviously, is the transmission distribution losses, and that will require significant infrastructure investments into the transmission infrastructure in India. And again, the question that one has to answer there is who pays for it and how do you pay for it? So if you're going to obviously transmission infrastructure down in India can be owned by private players, but the question is, what is the payment mechanism that ensures that investor gets paid? And you need more clarity around that contract, that payment mechanism. So the power sector, and the third issue is obviously the economic viability of these projects, in the sense, if large projects were set up 5 years back, 10 years back, 8 years back, and definitely learnings must be taken from these projects in the future, one has to really look at what were the offtake agreements and what was the pricing of these assets. I mean, at the end of the day, this again comes down to the lending aspect. So if you have lenders lending to these projects, what evaluation was done back then? Did we look at scenarios that were extremely rosy, or did we take a more practical approach to valuing these assets? It's all interlinked. So going forward, how do you resolve this sector? You have to have a discussion on pricing. You have to reduce your transmission distribution losses. And for any future projects, not just for thermal power, but even for renewable energy, the question needs to be, is the lender, is the financier of the project, is their risk aligned with the risk of the developer of the project? And second, are we considering all the different scenarios possible while pricing the project, as opposed to pricing in what is essentially a very optimistic scenario? And obviously,
But why are those price inconsistencies flowing in? Is it a function of like just privatizing all of it and making sure that the natural forces take care of it, right? I mean, because there's obviously there's a cost of input there, right? But in terms of the output, there's a natural subsidy which has been fed in, correct? I mean, from a consumer interest perspective or whatever. I mean, do you think that kind of structurally skews the entire value chain to some extent? Or you think, because I mean, in case of India, there's always a dichotomy, right? You always have the bottom of the pyramid consumers who you cannot throw things at market price at their end, especially for utilities, right? No matter how capitalistic we might like to get, right? I mean, that will always be an issue. But the thing is that entire treatment right now has been probably, that entire demographic has been painted with the same brush in terms of how the pricing mechanism works. Because I mean, a lot of these things are interlinked to each other, right? So, but the biggest thing is, as you said, who's going to pay and how much are they going to pay for, right? So, is that the biggest, most urgent thing that can be addressed? Do you even think that is something viable to be addressed?
So, I think in the short run, you need to have a debate on that. I don't think privatizing the entire ecosystem is a solution that's viable from any aspect. But I think on a project basis, there needs to be, going forward at least, there needs to be a lot more analysis from financiers of these projects in terms of how those contracts design. For instance, if you have a large project being set up whereby your input prices are variable, that is essentially was a thermal project set up with coal prices obviously moving around, and your price that you can charge your consumer is fixed. If you're financing that asset and you understand that sector well enough, the question you need to ask is, what is the buffer that's being left to price in variability around those input prices? And for a lot of the projects, perhaps in the past, not a lot of buffer was left, whereby these projects obviously had...
Is it due to lack of sophistication of the financiers themselves, or is it because there are some other forces at play?
Or lack of financial products that can sort of streamline that risk?
I think it's a mix of factors. So you have obviously a lack of products that possibly can address that issue, a lack of capacity within the financier to actually study that project and come up with an analysis that works. And overall, also maybe the need for credit markets where lenders who have a lot of skin in the game can really go in and make these calls better than can.
So who's typically financing a power project?
So in the past, you've obviously had public sector banks take on the majority of the load of it.
Right.
Going forward, obviously, as renewable energy market picks up, and you will see a variety of different players coming in. So you obviously had a lot of capital coming from abroad. But again, in the long run, for that capital to succeed, you need financial products that work, and you need government policy that's consistent. And these investors will be in a better position to judge what the value of the asset is, and therefore at what levels you should finance that asset.
So funny, you talk about foreign players, and I think this was this morning I was reading Brookfield Asset Management getting their first renewable energy bet. I think bought a couple of wind farms. So clearly a sector that even you outlined, upfront as one of the sectors that one should probably look out for. And I guess there are some India-specific nuances to it as well, based on how we are progressing. But is that sort of a vertical in the energy or power, let's call it the broader power sector, that you think will attract a lot of international capital, private equity or otherwise?
I think renewable energy in India has seen a lot of interest in the past few years, and it continues to see plenty of interest. But again, even for renewable energy, I think we need to factor in that the market shouldn't get ahead of itself in terms of when you're looking
But
at
like, what has been the different story about renewable? Let's start with that. In terms of like, obviously there's foreign pool of capital going in, not just the public sector banks like in traditional power. What's the different story here? Why are they being attracted to it? Is it because of the consumption side of things, or is there structurally something different going on?
there's two factors. One, that you've had a big push towards renewable energy globally.
Yeah.
Second, you've had a very, very transparent auction mechanism in India,
Okay,
which has allowed a lot of players to come in.
Right.
But there's two very, very important questions that investors have to ask of renewable energy. And when I say investors have to ask, I mean the government has to address, the investors have to ask. One is, for renewable energy to succeed in India long term, and it will play a significant role, you need an energy ecosystem, infrastructure ecosystem that works very well. For instance, if I have wind farms in Tamil Nadu,
Right.
and we repower the wind turbines, whereby we can essentially generate more wind energy from those wind turbines. The question is, do we have infrastructure that allows us to evacuate that energy from the source of generation to the source of usage? Second, who pays for it?
Yeah.
And these are intricate questions that have to be addressed and answered by investors and the government. Everyone has to get together and figure out a solution for this. What you do not want to have is renewable energy projects getting set up at different stages in the sense, but not having the infrastructure ecosystem within the grid to absorb that renewable energy.
Right.
And even moving one step beyond, if India needs to have that renewable energy capacity, you need land.
Right.
And the more renewable energy you want to generate, obviously as technology improves, you generate a lot more from the same space. But overall, given India's energy consumption, you need land. And the government needs to really, and land acquisition in India still remains an extremely challenging
Interesting
issue.
because, like I was watching this, Raghuram Rajan's interview with Ian Bremmer, where he's kind of talking about, obviously it was a more neutral interview than I had expected. So I was kind of a bit disappointed there. But he ended his thing, like in terms of what should be the future steps. Land acquisition was right at the top because he was comparing an economy like China, where obviously you have one party system, land acquisition is much more efficient as a result, which enabled it to become a middle income country. And in India's case, obviously we are not there yet in terms of achieving that middle income road, and land acquisition is one of the biggest levers there. So it's a very, very kind of
So I think
that you mentioned that.
overall, absolutely. So you need to address that issue. And again, this is an issue that will not be resolved through overnight policy changes.
Yes, it's a civil society issue, right?
Exactly. It's an issue that has to have not just finance pricing, but also social dynamics pricing.
Yeah.
But what's very important is for renewable energy to kind of build up in India. And as India gets into that space where the energy consumption booms up, is also the government needs to start thinking about how could you possibly get into a space where not only are you tendering out not only tendering out contracts, but you're actually tendering out contracts with land with it.
Right.
Yeah.
Because what you do not want to have a situation, and which some developers have faced in India, is whereby you have essentially won an auction, but you're unable to get the land to complete that project. And I think those different nitty-gritties is where I think the government is very, very well placed to resolve those. I think the government is the best placed as opposed to a investor or a developer or anyone, whether it's in India or abroad. I think the government needs to start innovating on those aspects. And this is something that can be utilized not just for renewable energy, but essentially provision of that land in a very transparent, clean format needs to be done for other assets as well. And that's when what you'll see is you'll start seeing operationally savvy, large investors, both in India and foreign capital, automatically coming in and start looking at assets that are not purely brownfield.
Right.
And that has to happen for India to really create that infrastructure. And that has to happen for foreign investors to actually come in and park the kind of capital that they want to allocate towards the India story.
So in terms of that, like I think land becomes like one of the biggest inputs right here, which has to be resolved, right? And obviously you talked about pricing mechanics, you talked about a lot of other factors, and I think what we often feel is, what we often kind of are victim of thinking is that the ecosystem has inertia, right? By default, like nobody's going to like say that I'm going to fundamentally drive change if I'm just one of the stakeholder. That's why I guess the government comes in. So no, that way it's pretty fascinating how you're kind of putting the loop on all of these factors together. I would like to talk about a bit about the capital side of things. And when you looked at be it REITs, be it InvITs, that entire idea of pooling assets. They're basically pooling tools, right?
Absolutely.
And in terms of REITs itself, like we are reading embassy REITs,
yeah.
right? That kind of came in and went.
Blackstone.
Yeah. What's your view on these two structures? Like I recall on InvITs, you yourself have extensively commented on with what do you think are the main plugs and gaps to be sorted out? Because they are again one of those fundamental drivers. Once they are in, a market gets created, and then stakeholders come in and participate, right? What's your assessment on InvITs and REITs?
So I think India's made a good start, as I said earlier. But there are two very, very important aspects that India needs to keep in mind. By India, I mean the regulators, the policymakers. One, I don't think it's important to have retail participation in InvITs and REITs at the moment. I think what's important is to provide institutional investors some degree of liquidity. Mm-hmm. And what that would do is bring down the liquidity premium that investors charge to get into Indian assets. And the primary aim of REITs and InvITs will be to provide that liquidity, whereby essentially you lower the cost of funding for these projects, thereby making more projects viable. Right. The second aspect that REITs and InvITs have to play in India is in getting large investors who are not operationally savvy to come to India and invest. For instance, if you are a $400 billion fund or a $200 billion fund, you have the operational savviness, in the sense you have the resources to come to India, have a local office and run the business.
Right.
You could be a large pension fund that is like $10 billion. In the pension fund world, $10 billion makes you a relatively small pension fund. Right. But you still have a lot of assets that can get allocated to India. And what REITs and InvITs can do is allow many of these 5 to 15, 5 to 20 billion dollars.
Who want to stay hands off.
Who want to stay hands off were financial investors who are not interested in operating a toll road in India.
Right.
And what you create is you create a market that allows developers and operationally savvy investors to come in, possibly take up projects which aren't quite brownfield but are semi-complete, take those projects, take on the remaining construction risk, earn that premium, transfer that asset into an InvIT, and get many multiple relatively smaller investors who still have significant pools of capital to come in and invest the money. And that is what InvITs and REITs essentially will do. Of course, on the flip side, one has to
like for the benefit of the listeners, I mean, obviously these are fairly technical issues. So if you have to break it down, so you're basically saying they might be like multiple assets, say around the same geographical location or whatever, and those multiple assets are looked at in combination through a vehicle such as a REITs, correct?
Exactly. So I mean, you may have a wind farm in Tamil Nadu, you have a wind farm in Andhra Pradesh, you have a wind farm in Karnataka, and you have someone who puts these assets together, puts them in an InvIT, and essentially in a very, very basic way, the return on the InvIT is some function of what cash flow that asset
behaves like a mutual fund.
Effectively behaves like a mutual fund.
Right.
And that allows all these assets to essentially generate value for those small investors, but that's a good description of it. And as I said, going back and I reiterate, is it's important for India to provide those institutional investors some liquidity, and that will be a huge component of enabling capital to flow through India, not just for foreign investors, but even for Indian investors. I think one issue that a lot of investors face is primary issue in finance is obviously if I get into an asset and I know I can't exit the asset for 15 years, 10 years for liquidity, I would have to charge a lot more. I would price in that premium into that asset. Yeah. And that becomes a negative feedback loop whereby obviously basic finance, I'm going to value assets to be in a certain way because obviously as my cost of financing goes up, a lot of projects become unviable. As my cost of financing comes down, a lot of projects become a lot more viable, and thereby you can generate successful, viable projects even in areas or spaces where you possibly weren't able to do that in the future. So InvITs and REITs have a significant role to play. And again, I reiterate that it's much better that we go moderately slowly with incremental changes and work with the feedback loop in the market. And it's better to do that than try and do things very fast and essentially probably realize later on that things could have been slightly different. And that's just my take on it.
You're obviously not thinking like a politician, are you? In terms
Politics
of-
is definitely not my cup of tea.
I mean, they would be like, what? Like 5-year horizon, incremental? That just does not sound good.
That is, politics is way over my pay grade.
And it's interesting, and read sort of from I mean, I know retail is like we talked about retail investors, the role they play, and probably a little ahead in the game on that front when it comes to infrastructure, but they also act like bond proxies, right, for retail guys. Like, I mean, they want that predictable cash flow backs and dividends and things like that. So for smaller projects, like, let's not talk about the big ones which require a pension fund. For those small little builder projects, is REIT a viable play for those guys and get some retail money? Or do you think, as such infrastructure, we're talking about such a big scale, we're talking about power projects, like it's better to just take it slow and see how it organically grows and let supply demand take its own shape, right?
So I think retail participation has a lot to do with investor education for the retail participants.
Yeah.
So if you want to invest into real estate projects, then you can't demand overnight liquidity in those assets.
Right.
Yeah.
So if you will have structures, whether it's through a mutual fund structure or through any other structure that allows a retail investor to invest into certain bonds or certain instruments that give you exposure to those assets, then one cannot expect to have overnight liquidity. And obviously, retail investors need to get educated on that.
Yeah.
And eventually, if those assets are tradable instruments, then obviously you get a certain amount of liquidity because you can go and trade that.
Right.
But from a very, very practical point of view, I think we're still very, very far away from a stage whereby retail units in REITs and infrastructure investment trusts will have.
And I think it will anyways quickly become a consumer interest issue, and it will actually put the entire trajectory off, right?
So I think the key is you have limited resources. How do you allocate that best to generate the best returns? A bit like a finance, right? Whereby you have obviously classic economics, whereby you have finite resources and infinite uses. Thereby, how do you kind of generate returns? And I think the best focus is getting institutional investors liquidity, come into that space, let that space evolve, and then eventually further down the road, one can obviously look at what role retail has to play in that. Because otherwise, what you risk having is market disturbances because of certain market panic that can get generated because retail investors want to exit an investment and they can't exit the investment probably due to the fact that the investment fundamentally doesn't have liquidity.
Yeah.
And to start with, there was some level of lack of retail investor appreciation for the risks that the project involves.
Right. In terms of like retail, aviation is something that every retail, I won't say investor, but any retail user loves to talk about. And I'm pretty sure you get a lot of questions on that as well. I mean, it's a sector which is in
always in the news.
Yeah.
Always in the news.
Glamorous sector.
People when they check in, baggage gets lost. That's also a factor. When oil prices go up, that's also a factor. In the aviation space, I think now Indigo is going through NCLT. That's also interesting.
So we've had Boeing. I mean, we look at the entire ecosystem. We've had Boeing with their 737 Maxes make the news.
Yeah.
We've had Jet Airways obviously in the news. Now we have Indigo, and people are buying airports and whatnot.
Right.
So it's the entire ecosystem.
Yeah. So within aviation, obviously, there are a lot of parts of that value chain. Let's talk about the two ones which are the most obvious: the airline companies and airports, right?
Yeah.
I mean, I often feel that the entire kind of narrative which comes from airline companies is that ATF prices are so high and oil is going up, that's why we are really screwed. Do you think that's really the case, or do you think there is something? I sense there is something fundamentally off with a lot of the private aviation
Operators.
companies. I won't comment a lot on the PSU aviation companies. I think that has already been discussed adequately since independence in our country. So. But do you think like aviation entrepreneurs need to get their act together?
So when you look at the airline sector, when I was
this is the glamorous part of our podcast today, this one right now.
For sure. So when I was at INSEAD, we had all these different cases that we did, and the one realization that I had was airline business was a tough business.
Yeah.
And it's a business where I guess there's obviously these questions around pricing power, again, tremendous exposure to your input costs, which is like 40% of your costs essentially. So if you look at airlines in India, you've had a mixed bag, right? You've had some tremendous success stories. Indigo obviously being a huge success story. You had SpiceJet's done very well. They've had their ups and downs, and then they've come back.
Yeah.
And now you have issues around Jet. And while I think input prices are obviously a huge driver, of the issues that airline sectors can face. I think airline strategy also has a role to play in that, in the sense if you're doing buyouts, if you're buying out a rival airline company, whether the planes you're buying out matches with your needs, whether the routes you fly matches with your needs. So I think when you see issues in that space, because a certain company that isn't doing that well or is under duress, it's a mix of factors, and it's very, very hard to really pinpoint and say which factor was a larger driver. But surely I think airline strategy is also a significant contributor.
I guess you're referring to things like utilization, right?
Utilization of assets, what assets you want to have, whether you want to have all your fleet needs to be just one kind of plane, or whether you... So I think those are all issues that have to be dealt with. But overall, the reason you see a lot of interest around Indian aviation, the airlines and the airports, is primarily because it's a very, very fast growing market. So obviously, if you're an investor in that space, whether it's in baggage handling, whether it's in providing food to the air travel, whether it's in, as I said, the airline and the airports, it's a space where you want to be involved in. And I think in a larger picture, what's also very important is, as a society and as a country, we also need to get used to businesses doing exceptionally well, and more importantly, businesses not doing that well. Just because a company goes bankrupt, and that's obviously unfortunate because they employ people, they have contractors, they have vendors, but that is a natural part of business dynamics.
Yeah.
You're going to have industries come in, you're going to get disrupted within the industry. In certain spaces, you're going to have industries, you're going to get disrupted because that industry dies out. And because you're going to have a new industry, new trend, new entrepreneurs come in and do things differently. And that's always going to be the case. You look at the US, you see Sears, right? I mean, Sears went into bankruptcy. I mean, Sears in the 60s and 70s, it was unthinkable. I mean, they were like they predated Walmart.
Yeah.
And then Walmart came in. And then Walmart revolutionized the market. And then Walmart faced significant pressure from Amazon. And that's always going to be the case. Obviously, one would hope that as the economy expands, your growth companies and your growth overall is much better than the bankruptcies. Bankruptcies in itself allows inefficient businesses to die out and efficient businesses to evolve and grow. And that is an important component of the modern economy.
Yeah.
Rather than businesses sustaining when they do not have the capacity to compete in the market. So, I think people...
But is aviation only is the biggest headwind competition?
Headwind. I like the wordplay.
Yes, I know, sir. Totally unintentional.
I think competition is good for the consumer.
Yeah. But I mean, don't you think that a lot of aviation companies don't understand the concept of debt and have gone wrong?
Not really. I think, when I look at the aviation companies that have had issues, I think it's more a strategy issue. Obviously, when you price in that debt versus the strategy and your cash flows don't work out on the revenue side, obviously servicing that debt is challenging.
Yeah.
And again, it comes back to the question of the lender. Does the lender have the capacity to finance the whole debt burden for that company? Does the lender have the capacity to deal with a bankruptcy situation? Because if I'm a lender, for instance, if someone's a lender which lends to aviation businesses in the US, and there are specialized lenders who just do aviation,
Right.
They possibly have a lot of operational bandwidth to take over a company, turn around the business. And if you're a lender who's taking on 60%, 70% of the debt for an aviation company, the question is, what do you do if that company doesn't do all that well in the future? If you do not have the capacity, the operational bandwidth to really deal with that, then the question becomes, should that be a syndicate lending out to that company, or should you be taking on 60, 70% of the debt? And these are all, again, go back to the basic issues we discussed around credit markets in India, creating credit instruments, creating contracts that allow various different players with various different balance sheets, various different operating capacities to really come to the market and operate the market.
I mean, that way, I feel that the biggest private equity company in India is State Bank of India, right? They do restructuring, they buy NPAs, they buy loan portfolios, right, on a standalone basis. So I think being jack of all trades can hurt everyone, right? And what do you think about airports? That's a different piece of the pie. Obviously, there's a lot of interesting investment angles there, both at obviously at the hubs, but the regional level.
And there has been some news around it as well in terms of picking up, was it some airports being auctioned off?
A lot of them actually. Yeah, so I think there have been some transactions around GMR as well.
Yeah.
Change of control, things are moving around. A lot of movement happening there. What is your view on? Because that kind of comes obviously there's a consumption pressure here, right? Then schemes like Udan came, which kind of quote unquote are supposed to push for regional traffic. I don't really know whether the regional traffic has enhanced. You always keep on hearing about host airports in different cities, but then on the other hand, on the investment side as well, there's a lot of interest. What is your like overall net assessment of that particular?
So overall, the sector, airports remain a very, very attractive sector for investors. I mean, it's a very, very GDP-related asset. Right?
Okay.
So what you're looking at is high consumption, high GDP growth. The growth rates can vary, but overall, there is, as the income levels go up, people are going to fly planes. But at the end of the day, it's also a very, very asset-specific investment. Right? So what you'll see is there'll be tremendous investor interest around good, high-quality assets, a bit like the highways. And going forward, you will see slowly but surely, you will see more private participation in developing these assets. But again, airports are no different from other assets in terms of how do you attract investor interest. There's obviously a lot of investor interest, some money's coming. And historically also, airports in India, Bangalore, Delhi, Hyderabad, they've always had foreign capital participate. Mm-hmm. The question is, how do you kind of take that next step and get the relatively smaller but faster growing airports to participate in that? And the answers for that are again linked to all the different points that we've already discussed.
Right.
But a very attractive sector nonetheless.
So I think we covered a fair bit of ground today, Sharad, didn't we?
We did, and
Taponeel, I think probably we need to top up your cup of coffee. I mean, we have been speaking now non-stop for 56 minutes.
That would definitely help.
Yeah, for sure.
Time has flown. That's another word play on aviation.
Yeah, I mean, they just keep on coming, don't they? But no, Taponeel, thanks a lot for this chat. Hope you also enjoyed this interaction. But yeah, I mean, we certainly had a ball, learned a lot.
Yeah,
I hope the listeners, I have a feeling the listeners might have to like refer to some sort of an investment glossary on the side.
So will I.
Yeah, I mean,
subsequent to this, and for me, one of the biggest takeaways, which I found very interesting, was how aligning interest at contractual level can have such deep impact. It's not something that intuitively I thought about ever, but
if you look at the breakdown of the ease of doing business rankings that we like to, it's legal enforcement and contracts is I think slow moving piece there still, right? Yeah. So yeah, that's pretty much kind of fed back in. Well, no, thanks a lot, and
thanks for having me on the podcast.
No, true pleasure. And we would obviously invite all our listeners to share their valuable comments and feedback. Obviously, subscribe to the channel and spread the word. And yeah, with that, this is Nikhil Arora.
This is Sharad Tupran
signing off.